Respected economists and real estate professionals are starting to make the bold claim that mortgage rates could start already declining November of 2022. My goal for this video is to explain in as easy terms as possible why mortgage rates went up in the first place, and then why we're expecting mortgage rates to start going down relatively soon. It could be November of 2022, but more people would agree that it's likely to happen at the least by spring of 2023. The name of the game right now is inflation. Inflation is making everything more expensive. More dollars are chasing fewer goods. So, as soon as inflation started ticking up, mortgage rates shot through the roof as well. So what I want to show is a historic interest rate chart, which is going to be painful for most people to see, especially those who have recently bought a house or are hoping to in the near future. Through most of COVID, and due in a big part because the government was buying mortgages, which artificially lowered mortgage rates. In fact, this very activity of buying mortgages was inflationary, so it further exacerbated the problem and caused rates to go even higher as soon as they discontinued buying mortgage-backed securities. So right around October to November of 2021 was when we saw this turning point and rates started going up very dramatically. As soon as the summer of 2022, we saw rates in the mid 5s to 6s, and now today they finally broke over 7%. So what in the world is going on? Mortgage rates are based on how much the market is willing to pay for mortgage-backed securities. So what happens is I'm a loan officer, my company generates loans, and then all of these loans get bundled together and it becomes an investment that Wall Street can invest in. They're securitized and it's a very safe and frankly unsexy investment because it's based on the back of homeowners who are making sure to make their mortgage payments. So the rate of return doesn't need to be very high for it to be a more attractive investment for Wall Street because again, this dividend or rate of return is built on homeowners who don't want to get foreclosed on. So that's where mortgage-backed securities come from. That's where the pricing is derived. Now, if the mortgage bond itself becomes less valuable because of inflation, then mortgage rates will continue to rise because a higher yield needs to be offered to Wall Street in order to make that investment more attractive. So here's a month-to-month percentage change chart that is from the BLS. The website is bls.gov. So you can see it here, U.S. Bureau of Labor Statistics. CPI is often measured on a month-to-month basis, looking 1 year back. So to put it another way, it's a percent change from 12 months ago. So in 2021, this column is October. You can see inflation jumped up 6.2% increase over the year prior. This is the CPI report, and this is the basket of all goods that consumers are paying for, which includes housing and energy. Through the winter, it was starting to climb, and then we saw that big red hot number, 9.1%, and then now it's currently at 8.2. So here's the deal. Because inflation went up so high in October, this set a very high benchmark for inflation where we just need goods to not become that much more expensive, and then it will look, comparatively speaking, like inflation is starting to go down. So this is why some people and some respected economists and real estate professionals are saying that mortgage rates might already start going down November of 2022. So what does that mean for consumers? Those who are worried about buying a house right now can take relief in the fact that we are expecting rates to go down in the near future. Should they necessarily wait for rates to go down? Not necessarily, because if you buy in a house now, you lock in the equity that you can start building from day one, and then as soon as rates drop, you can refinance. So here's the deal. We have plenty of clients that consider the idea of paying extra money at closing to get a lower rate. So here's a chart showing two different scenarios that clients might see. You can choose a lower rate or a higher rate, and the difference is how much you're paying in points to get that particular interest rate. So in this scenario, it would cost $3,600 more in order to achieve a monthly payment that's $83.71 lower. In a normal market where we're not necessarily expecting rates to drop in the near future, this might be a desirable scenario because as soon as you've made 60 mortgage payments or within 60 months, you'll end up saving about $3,000 on your mortgage by means of making this additional investment at closing to lower your rate. And then that $83 a month savings adds up, where not only do you recuperate the $3,600 you spent in points to get that rate, but you've saved an additional $3,000. So that's the return on investment that we measure when clients are debating paying extra money at closing to lower their interest rate. All that being said, because we are expecting this big headwind change for inflation right around the corner in November, most of my clients are choosing not to pay points right now because rates will start going down and you won't have 60 payments to enjoy that partially lower rate because rates are about to go or more likely to go significantly lower where they'll end up refinancing anyways. And for those who don't know, a refinance is where you take out a new mortgage altogether, you pay off the old one. And generally speaking, most people do this because that new mortgage has such a lower interest rate that it becomes worth it to buy down that rate and to do a refinance. An interesting fact is that historically, every time inflation has risen, mortgage rates follow. So this is why we can speak fairly confidently on the fact that, again, as soon as inflation goes down, mortgage rates should as well. Here's a chart looking back to 1980, where you can see how inflation is a headwind that mortgage rates end up following. So almost every time that inflation goes up, mortgage rates go up as well. And as soon as inflation goes down, mortgage rates follow. So the white line is inflation, the blue line is mortgage rates. These gray vertical bars represent recessions. And so as you can see, inflation often spikes prior to recessions. In recessions, inflation typically drops because the market's cooling off and mortgage rates follow. So one of my favorite facts I like to share with clients is in 6 out of the 6 last recessions, mortgage rates have gone down. So exactly the likelihood you believe and economists believe that we will experience a recession within the next 12 months, we will be experiencing lower mortgage rates, so long as history repeats itself as it has 6 out of the last 6 times. If you want to learn more about the day-to-day changes in mortgage rates, there'll be a link in the description where you can follow along with this daily report. So this daily report gets a little bit technical, but what I do with my clients is we schedule a 45 to 60 minute video buyer consultation where we'll break down what does this mean for you. And more importantly, as soon as your offer is accepted, you can choose to lock in your interest rate or you can float, which means you're actually, your interest rate is not locked in and you're subject to market movement. We recommend that a client floats if we're expecting a positive headline in the near future that historically has led for mortgage rate improvement. So we discuss those more technical analyses during the 45 to 60 minute video buyer consultation. There's going to be a link in the description in the video to schedule a call with me, or you can apply for a mortgage for a pre-approval, at which point we'll schedule the buyer consultation. If you liked what we discussed in this video and want to see more, make sure to hit subscribe and ring the bell, and I'll be putting out more relevant content structured around what my buyers are currently asking me about.